Everybody, got another informed investor coming to you. Before I do, as Remembrance Day was this week, just want to acknowledge our veterans and pay our respects to those that served for our country, for all the freedoms that we now enjoy. I hope everybody took time on Remembrance Day to reflect and remember and pay respects to those that served and those that continue to serve our country. So thank you for that. But I will dive into our charts here, show you where the market's been, where it could be going, and as always, end with a few interesting charts for you. So here we are, all-time highs or close to. We've had some volatility through the last couple of months, but we have stuck close to those all-time highs, not exactly rising up as we saw the previous 3 or 4 months coming out of that spring dip. But you can see we're working on month 6 right now, being close to or at all-time highs within 3%. Not unprecedented, but definitely getting up there as far as a rally goes without any sort of correction off of that 3% number. Again, had little volatility, but lately it seemed like any negative day or 2 days in a row was quickly followed up by a rally buying that dip, so to speak. So see if that continues here. But good signs as far as seasonality goes. And we've talked about this before. Usually September, October are weaker months. We, again, didn't get any massive weakness through that. November, December, much stronger. And you can see, especially when the markets have been strong through the year, in all of these cases, save for the two up in the late 80s, markets have continued to rally through the last 2 months of the year. You can see 85% of the time stronger in November, 76% of the time stronger in December. Add the two together, and you're 90% of the time the markets have been higher when the markets have been over 10% leading into that November month. So where will we end up is anybody's guess. And we, of course, had some negative months to end the year, but seasonality is strong at the moment. You can see almost a 5% average return over 2 months, which is a very positive return. How do we get there? So lots of talk right now about how high valuations are. And we've talked before about some of the differences between the large tech companies and the rest of the market, both in the valuation side and the earnings side. So here is a hint or a reasoning behind why the market could continue to rally. You can see earnings are coming out. The actual earnings and the guidance for future earnings are both increasing a fair bit more than we've seen in the past, which is leading to some reasoning, I guess, behind why those valuations or why the stock markets can continue to rally. If those companies can continue to grow, then that leaves room for the markets to continue to go up. Maybe not to the extent we've seen over the last 6 months or so. But again, there's reasoning behind that. It's not just hope in a dream. There is estimates coming out, guidance coming out from these companies that leads to higher earnings, which of course the stock valuation should be based on. Looking back though, we do know there's volatility. As mentioned, we're on a kind of a 6 month, close to a 6 month rally here near all-time highs. We've seen pullbacks. Many are forgotten about. They've been quick. Of course, earlier in the spring, we had almost a 20% pullback, which you can see there, 18.9%. If we're looking over on the right side of this chart, the average being a 14% pullback per year. And of course, the average gain in the stock markets being around 10%. We're up on this chart, 14.4%. So it has been a volatile year with that big dip and now a big rally. But again, look at this chart. You can see the number of times those yellow diamonds, all the negative corrections that we've had in the year, and some of them very significant, while the markets have continued to give us positive gains. So not to say, again, November, December, seasonality looks good, but doesn't mean there won't be a correction. Another case for long-term investing, making sure your plan matches the risk levels of your investment, rebalancing those investments, and of course, diversifying, not just in the S&P 500 or the US market, as we've talked about plenty of times, and especially now, the outsized percentage of the S&P that is those large tech companies. Here's just a longer term kind of looking chart just to remind you of where we're at. So if we do have that 10%, call it average return for the markets, you can see the dark blue line there. Look at the differences that that can happen here. So March 2000, markets were booming, euphoria in the markets. Of course, we corrected all the way back under that 10% line, going back. This is from 1989 to today. And you can see in March 2009, when the markets had crumbled, how much lower we were on that 10% line. We've been working back towards that. We, of course, spiked over that, and then the pandemic drop, and now we've been rallying. And we are over that 10% trend line at the moment. But as you can see, that can continue to get higher, or we can kind of flatline as we move forward. Again, earnings can grow into these things. So we are over that trend line if you're looking back to 1989, but either a small correction or again, just slightly less gains through a few years could bring us right back to that trend line, or we could just continue to rally here. So there could be lots of room to grow. As you see from that March 20 or that March 2000, we were really in the same spot in about 1995. So there could be a longer term rally there. So interesting just to keep an eye on and see where we're at in the long term. A couple of interesting charts here for you. So these four quadrants here showing the last 5, 10, 15, and 20 years and the best stocks in the S&P 500. Highlighted NVIDIA there, as that's a big name. You can see it's actually not the best in the last 5 years, but has been leading the way over the last 10, 15, and 20 years. If you look back through this chart, lots of names you know, lots of names you probably don't know. Even if you're looking back at the last 20 years on that list in the bottom corner here, lots of names you may not have heard of that have done very well over that 20-year period. Just interesting to look at where we're at and take a longer term view, because as mentioned, some of those big tech names have really been dominating lately. You don't see as many of them, save for NVIDIA, as many of them on those longer term lists. So interesting to see there. And one more for you. We've talked a little bit about this in the past, but it continues to go in the same direction here, with first-time home buyers in the U.S. being a smaller and smaller percentage. So people not moving as much. They got longer-term mortgages down there, and of course, there's talk of making them even longer. But you see, only 21% of all home buyers in the U.S. are first-time home buyers, which is way off of the high you can see back in 2010 at 50%. So real struggle. Lots of talk about affordability, especially for younger people trying to get into that housing market. So that number continues to go, what many would believe, in the wrong direction there for younger people trying to get into the markets in the US. So that's it for me. A little bit of a longer one. Sorry about that. We'll be back at you next time with more charts as we move through the last couple months of the year and towards 2026. Take care, everybody.